Okay, ladies and gentlemen. Hi again from my side. Good to see you back again. Hopefully you enjoyed your workshops. Next point on the agenda will be another panel discussion. Throughout the course of the day, we've already discussed, you heard a lot about value creation, leverage, about the benefits of private equity. And this topic, or this panel is basically going to give you another chance to get a deeper insight into the different nature of private equity deals. And to be more concrete, the panel will discuss M&A versus proprietary deals, the key to success in Germany. And with that, I'm happy to hand over to Mr. Wengeler again, and please welcome the participants of our second panel discussion.
Yeah, thank you very much. Welcome to our today's panel discussing proprietary deals and whether proprietary deals are more successful, if they are around, and how the dynamics work in private equity and sourcing proprietary deals. I would like to start the discussion with a brief introductory round with our participants, and then second part would be a discussion around the dynamics, and then we have a 15-minute Q&A session at the end of our session. Mr. Hinteregger, maybe we start with the round here on the right-hand side.
Yes, my name is Hannes Hinteregger. I'm partner of Avedon Capital, and Avedon is a dedicated growth fund. So that means we're not only a growth capital provider, but we invest in growing companies, do that in the German mid-cap, and have been doing that all around in the last 12 years. And happy to look forward to the discussions, because in the end, this is what we're doing. We're not buying out of the wide auctions. We are buying the deals that are somewhere in the market that we have to look for. And let's see what the discussion brings.
Thank you very much.
Hello, everybody. My name is Michael Drill, and I'm a strong believer of M&A deals. If I would believe in proprietary deals, I couldn't have made my living for the last 20 years. I wouldn't have been able to feed my family and my kids. So I'm glad to be here to talk about M&A deals. I'm heading Lincoln International in Germany. Lincoln International is an M&A investment bank based in Frankfurt, but also based in the 10 largest economies of the world. Worldwide, we have 330 M&A bankers. And what we are doing, we are very much focused on sell sides. What we are doing, we are selling companies every year, around 130. Our clients are private equity groups. They are selling their portfolio companies with our help to other private equity funds or even to strategic buyers.
Thank you very much.
Daniel Neumann. I'm also a big advocate of M&A, like Michael is, on the sell side, when we sell something out of the portfolio. On the buy side, I'm a big advocate of the proprietary side. I'm a partner at a firm called Brockhaus Private Equity. We're around about 15 years now. And we have been focusing since inception on what we call technology and innovation leaders in Germany, and have been focused on doing this on on the sourcing side, on a proactive outbound program where we try to identify interesting market niches, interesting companies, and then get into the contact with the entrepreneurs and develop transactions from there. In order to do so, we have a pretty flexible mandate in terms of capital. So about 80% of our capital is committed to buyout majority type transactions, including leverage, and 20% is reserved for minority transactions, whether it's growth or replacement capital, where we take out existing shareholders of businesses. But a big proponent of the proprietary style.
Mr. Effinger.
Yeah, hello, Rainer Effinger. I'm from Nordholding. Nordholding is maybe one of the oldest private equity investors in Germany. We focus on small cap buyouts, typically enterprise values up to 70 million. And a part of the direct business, we also invest in other funds. So we have a fund-of-fund business. Let's say we have a good transparency about the market, and we have good transparency about proprietary or M&A wise source deals. And I'm a strong believer of good companies, so I don't care so much about proprietary or M&A deals. I would say it's more important to have good companies.
Thank you. So I'd like to start the discussion now, and I think the first thing I would like to get some ideas around is, are there actually any proprietary deals, and if so, and which ticket size? I've recently talked to another private equity professional. He said proprietary deals a little bit like the Yeti. Everybody talks about them and then rarely seen in the market. Mr. Hinteregger, I think you mentioned that you actually did proprietary deals. What is your, so to say, estimate? Are there a lot of proprietary deals out there? If so, where do they hide, or where do you can find them?
Yeah, if you ask me, especially in front of an audience, I would say there are no proprietary deals. Yeah. So but they are, and they are hidden. They are very hidden. You need to find them, and in the end, it's long work, long preparation that you go out and find them, and you have to identify them, talk to the owners, and it can take years. No? That's the difference to an auction. You have a process, transparent, with a willing seller, and quite probably a transaction at the end. So for the proprietary, you need to be out there, you need to talk business, and it will materialize, but it can take years. And on the other hand, it does happen, and our fund is the best example for that. We have done in the last 2 years 5 transactions, and 4 of them have been with owner founders. So yes, the hit rate then, if you look at this, 80%, that's not bad. But I doubt that will continue, and we have a 20-year track record on that, but for the last years it works well.
Okay, thank you. Mr. Drill, bad news for fees, 80% proprietary deals.
We are less concerned. I think these situations are less of interest for us. I think the deals he was referring to are probably more smaller deals. So deals which are of interest for us in terms of fee potential are companies with an EBITDA, let's say, exceeding 4 to 5 million euro. And here we see very, very few examples where owners decide to go exclusively with one potential buyer rather than going to an auction. And if this is the case, I think my competitors and myself, we did a bad job. Probably we have been lazy and we didn't come up with good arguments why to use an M&A advisor in coming up with an auction for selling a business. If you, in the audience, you have a flat or a house and you want to sell this house or this real estate, what will you do? Will you go on the street, ask the first who you meet and ask him, do you want to buy my real estate? No, this is not the way you are acting. You will go on Immo Scout or make an advert in a journal, or even you will hire a real estate broker. And this is the same for selling the business. It's not so easy to sell a business, so I think people are wise in asking a professional investment bank, a professional advisor, in conducting a structured M&A process.
Thank you. Other views. Mr. Effinger, I think you do not believe so much in a high number of proprietary deals available, or at least not good ones. That's what I took from your perspective.
I think the first thing what we have to mention here, all people here sitting around are mainly focusing on small cap transactions. So the larger the transactions get, the less proprietary chances you will have. Above 50 million enterprise value, I would say maybe 5, maybe 4, maybe 3% of the transactions could be proprietary, whatever proprietary is. That's also another question. But in our sector, for sure, there are more transactions which are, let's say, not that efficient in the process and where you could have an exclusive access at the beginning towards the seller. But if I would look, for example, I was just thinking about what were our best deals, so the deals where we make multiples on invested capital of, let's say, exceeding 10 times. So the best deals were all deals which were not proprietary. These were deals, for example, spin-off, very complex, a lot of problems. Nobody saw the potential of the company. So there was an M&A advisor. The funny thing, the M&A advisor told the seller, don't sell the company, the price is too low. But he had to sell because the seller also had a problem. So I wouldn't say that at the end it's a question of proprietary or M&A, and it's also not that proprietary must mean that it's cheaper than M&A deals. It's the question, do I find the right company? Do I have the right focus? Do I have the right idea about what kind of sector I invest, what kind of situation I invest? And that's, for me, the most important thing for success.
I think Mr. Effinger is very right in saying you need to see something maybe some others don't. And whether this is in a proprietary situation or what quasi-proprietary situation or an M&A deal, it doesn't really matter. I mean, if you're in an auction, price will matter, and you will only be able to win it if you see value creation along the line that is, you know, exceptional, so to speak, to pay a full price. And the question is very, I mean, it's very right also, is what is proprietary? I mean, the deal that is sourced, executed, and then done without the entrepreneur, family owner, or financial owner asking someone else are super rare. And I think this is independent of the size bracket. The situation where it's a quasi or a very limited type option, I think there are, on the smaller scale of the market, are more often. And I think the German market is quite prone to it because the entrepreneurs and family owners, they do like confidentiality. I mean, what they fear most, and this is, for example, very, very different to France, where the entrepreneurs love the big blow of a large auction, and it's in the newspapers, and they know that they get the best price and do this. On the German side of things, the entrepreneurs are typically, everything is classified, and they're very shy to take this out. This doesn't mean that they don't talk to a few people around. And I think in occasions it can very much help to have someone like Michael involved to moderate this, and to make sure that the entrepreneur or the family owner eventually gets there and signs the contract and sell it, and feels comfortable that he has done the right thing to do. And I would say in 90%, 80% of the time, at least there is some other interested party, whether invited or hovering around the asset, that you need to fend off in order to do this. But it all starts to be there early and to be in contact with the entrepreneurs. And as I said, we do this on an outbound basis. And as an example, the deal we're working on right now, we know that the seller for about 3 years now. We have basically told him 2 years ago, we will not buy your business without you having a successor in place so that it's a true MBO. And he basically then hired a successor for him, worked with him for the last 2 years and 2 years and a half, and is now back to market. And now it became a structured process. It's not a very broad process, but it's a process. And we still, on it, and we like to do it, and we like to follow on, and we love the business. And it's the right thing for him to do. So it's nothing bad about it. It's just the way the market works, I guess.
Okay, thank you. Maybe some. So I take here as a key takeaway. There are proprietary deals. Sometimes it's probably difficult to say there's a systematic, so to say, percentage of proprietary deals, but there are those around. But the key is that it's a good deal and that the asset is good and that the strategy behind it is good. What you said, I think it's important to see something others don't see, which is a kind of an inefficiency, but it's important to leverage on that and in the strategy and execute on that. Do we, maybe another question on proprietary deals to Mr. Drill. What do you think, is there any sector or time when proprietary deals are more likely than in other times, or do you see right now that there's a trend of less proprietary deals? I think we mentioned before that if proprietary deals are around, the likelihood of them happening is less than 10 years ago.
Yes, absolutely. I think over time, the numbers of sell sites which are not auctioned came down dramatically. And if we look 5 years ahead of us, probably we will only see very, very, very few situations where someone will decide to sell exclusively to one first potential interest party. I think the smaller the company, the higher the likelihood that someone will say, as Jan indicated, I don't want to take the risk of a huge leakage. I don't want to hit the market with 20 or 30 potential buyers. I want to keep it confidential. I think the smaller the business, the more it's a really family-owned business where the owners really care of the business, care of management teams, and don't want to make too much noise around it. Then the likelihood is higher that the seller will only talk with one or two or with three parties. When we look on the other side of the pond in the States, our colleagues, when they're selling a business for a private equity house, normally they're approaching 150 potential buyers. They're approaching around 50 strategic buyers around the world and maybe 100 mid-cap PE houses. In Germany, if we are acting for Brockhaus, for Note Holding, or one day for you, maybe we are asked maybe to approach a dozen of strategic buyers and maybe another dozen of financial sponsors. So it's already a completely different culture. It will change over time, I guess. It will become more broadened over time. So the smaller the business, if the owner is really very much entrepreneurial and concerned about this business and more has a stakeholder view than a shareholder view in order to maximize its proceeds, then you will see these situations.
Yeah. And I think another sector, I think which we mentioned before, was tech deals with minority stakes, where a different, I think, investment approach, like houses like TA, Summit, or GA, also approach it in a different way. Tech growth.
Sometimes, if owners believe they need to collect very quick money and they only want to grant a minority, or maybe if it's a kind of fire sale situation where an owner say, I need to sell my business for tax reasons because I have a huge tax burden in my family and I need to resolve this in a couple of months, then people might be inclined, you know, to go in a very exclusive small sales process. But otherwise, I think professional and rational owners will more and more intend to set up a structural M&A process, which will be more competitive. Because this way of approaching the sale will increase transaction likelihood, which is as important as maximizing sales proceeds. At the end of the day, if you want to sell a business, you don't only want to see the money, but you want to make sure that you have transactions within a certain time frame. Because otherwise, the entire company and the entire management team might become shaky and you will have huge problems.
Okay. So, Mr. Hinteregger, was it a valuable point to say you saved time, you had great success in sourcing proprietary deals, maybe for the next year, you go into auctions, maybe with Mr. Drill, maybe not, to have some quicker processes to buy companies, or would you stick with the proprietary approach? I mean, I understand your ticket size is a bit different,
our ticket size, we're buying companies from 25 to 250 million of enterprise value. Those are the ones that we buy as a majority, that we can take over completely, also in a buyout structure. There's larger ones where we then only take a minority. Yeah, I mean, for the timing, we have to see if Michael and I, if we ever get together. Yeah, but you're looking for the sell side. Yeah, on the buy side, I mean, it's also a lot about market timing. No, I mean, what's the market today? No, this is a seller's market. There's a bunch of really desperate buyers out there. There is banks there that have enough, too much money again. So yes, of course, that spurs the auction market, but it is what Michael says. It can turn into a hit and run market, no, and this is not sustainable. And on a sustainable side, the auctions will be structured well, but that's also what we are doing. No, when we go and buy a company, it's a bit what type of company are we looking for, and if we can find that in an auction, highly welcome. I mean, then we are there for the auction. It's not that we avoid it and we don't do that at all. I would say naturally 1/3 of our deal flow should come out of that. It happened over the last years that this was not the case because we're too busy with the other ones that we sourced ourselves. But that should be a good ratio. And then the companies we are looking for, we need to really dig deep into these companies. And very often this is not possible in an auction. It's not, they don't really like this. No, if we then want to sit down with them, have our management workshops, and not only one meeting, but a 2-3 day workshop, but that helps us to identify the right company. We really want to know what's the potential of this company, and it has to have the potential to grow and to really tremendously increase in size and in performance over the years. And that you can only find out if you know a lot about the industry, if you're deeply involved, and if you really sit down with them. So that's kind of which blocks us from the auction. And then we have the other way to go. So if the companies and Michael doesn't come to us, we have to go to the companies and look ourselves.
So organize workshops, maybe. Then Okay, good. Thank you. I think it's an important point to really build at an early stage this closer relationship with the founders, and then have a different approach towards buying a company. I wonder, Mr. Effinger, is this something you could imagine for your fund as well, to say we source and workshop and have this different approach with your fund, or would you say just the asset class you mentioned before is just too big for that kind of approach?
I think the problem about M&A driven processes is that sometimes, I mean, you get a lot of opportunities in M&A deals. And the risk is that you stick only to these processes. And then you could, without any problem, put 150% of your resources on it. And then you have no chance really to go for proprietary transaction also. So I think the most important thing is just to be selective, take the right things. If I would look on our, for example, on our portfolio, for sure about, let's say, maybe it's not 50%, but maybe it's 40%, which are not auction deals, which we did. If I look on our deal flow, for sure, 75% are auction deals. So you need to have the resources to go also for non-auction deals. But so, like I said before, for me, the question of auction or non-auction is not really relevant.
Okay. Good. Jan Philipp.
Jan Daniel.
Jan Daniel. 50% right.
50% right. That's the 50% Mr. Effinger mentioned. Now I think it is about selection, is about deployment of resources, and I think that we are quite, I would say, aggressively in terms of resource deployment. I would say 80% of our resource deployment on the sourcing side goes into active sourcing to develop transactions. And I think the reason is that we have seen over the last 5 years or so, especially since the crisis, a lot of broken processes. That's one aspect. The second aspect is that within the processes, it takes a reasonable amount of resources to understand what the true picture of the company really is, because the science of adjusting the numbers have increased or has professionalized quite a bit. So you do find situations where there are revenues shown in books that are not there because of a customer that should have been won 3 years ago but was not won, and if the customer would have been won, it would have been that revenue. So to work through this and see what is the true quality of the asset, takes a lot of time. And then I think number 3, it also boils down to the professionalism of the M&A advisor. And I think one aspect is that Michael with his firm, for example, he cornered the market in the mid-market. I mean, he's the clear market leader in Germany for M&A in that size bracket that he mentioned. And the reason for that is very professional work and is a certain I would say level of quality that others certainly lack. And if you have, I mean, there's nothing worse than being in the process. You spend a lot of money, and you basically see an unprofessional M&A advisor that losing his client and is basically not able to drive his client towards the finish line because they're completely out of control. And that was very, very disturbing to us. So it's not all about pricing. It's more about the quality of the asset. It's the quality of the process of the M&A advisor that is behind it. And if that is all check, then we have no issue to go into an M&A process. It's more the question of resource development and where do you deployment and where do you see your success going forward.
Thank you. I think quality of the advisor, obviously, I think an important point we obviously in the process haven't actually talked about before. I think that is that is absolutely makes a lot of sense, Mr. Drill, from your point of view, and I think that was very clear that you have particular strengths in this particular field. And how would you characterize what are the key pillars of success when you do an auction? So assuming we don't go for proprietary and we say an M&A process adds efficiency and value for both sides, what would be the key, so to say, differentiators over maybe not so good advisors? Is that something you can elaborate on?
the key success factors in running an auction compared to a more exclusive situation.
Yeah.
I think if you run an auction, I think the window in which you hit the market and you put the company up for sale is much smaller than talking with one party. What we are doing when we are engaged for an owner, if we sell the business, we are preparing the business for sale. So we are preparing a data room, we are preparing marketing material. And during all this time, when we are polishing the bride, we are not approaching investors. So the company can still focus in doing, the normal day-to-day business. They can focus on improving profitability and generating revenues. And then once we prepared everything for sale, then we hit the market, and within a time frame of 2 or 3 months of very intense work together with the management team, we will come up with a solution. We will come up with binding offers. And then the owner will be able to execute a deal with a very high transaction likelihood. And I think this is much better from a point of view of a seller, rather than just talking with very few parties, one after the other. He will not find transaction security. He will not be able to prepare all the numbers which are necessary for selling the business. He will not be able alone to organize a data room, which is important these days to sell a business. And we have been talking now more or less with a strong focus selling a business to a private equity house. In an M&A auction, normally you try also to reach strategic buyers. In our M&A auctions, probably in 70 to 80% of the cases, we are selling the businesses to industrial buyers, to strategic buyers. These strategic buyers will only be able to come up with a binding bid if the company is well prepared for the sale, if we come up with all the numbers, as Jan indicated, if we come up with marketing material, so that the strategic buyer will be able, based on our paperwork, based on a data room, to come up with a view whether they will come up with a bid, and they need to go back to their own internal decision bodies as well. And it's very difficult for a strategic buyer to buy a company in a very exclusive situation, because the company will not be able to for sale, because the numbers will not be well analyzed beforehand.
So just basically being prepared for a faster process, and that would be against a proprietary process. And second question would be, what would you consider the key success factor versus other advisory houses? So how do you differentiate yourself, or is that difficult to say?
I think in our industry we have lots of very smart people. Our competitors are as smart as we are. They're all as lazy as we are. I think the small difference probably is a global footprint. There are only very few M&A investment banks which have a global presence. This becomes more and more important for our job, and this is something I will talk to later on when I have my lecture on exits and the difference between financial buyers and strategic buyers. I think our USP is that we are able, for our clients, for sellers of businesses, to approach strategic buyers in the entire world. These days, there are only few competitors who have the same reach like we have. The second very important USP is to have a critical size. If you are an M&A advisor, you need a critical size in your market in which you are acting. We, for example, in Frankfurt, we have 50 people on the ground. Together with Rothschilds, we are the largest team in Frankfurt. This is very important, because when you have critical size, you will be able to position yourself alongside industry verticals, alongside industry groups. When we are pitching for note holding, for Brockhaus, or for other owners, for business, it's important to provide to your client global reach, but second, it's very important to provide also industry knowledge, industry expertise, a good understanding of strategic buyers along in the entire world. And here you have some advantages if you are larger. So my advice to an owner would always be, if you want to hire an M&A banker, and you want to sell the business with a premium to a strategic buyer from abroad, then hire an investment bank with a global reach and hire an investment bank with a critical size.
Okay. Yeah, then I think we touched most of the topics, which I wanted to.
Maybe I can add something about M&A process, not about proprietary things,
Yeah.
because I think most people have a wrong picture about M&A process and the dynamics into it. So I would ask Michael about how many percentage of your deals you do, and you do 150 a year. How many of these deals would you say after the, let's say, the first phase of the process, so where you get first bids for the company? So in how many of these processes do you have more than two really, let's say, bidders where you would say, okay, they have a chance to buy the company? More than two after the first offer period?
It's very good, very interesting question. I would say it depends the M&A environment. These days, unfortunately, we are not acting in a hot, active environment. The M&A climate in Germany is so la these days. In the current environment, let's say, on an illustrative basis, we approach a dozen of strategic buyers, maybe 20 private equities. Out of 30 investors, which we approach, we will get 20 signed NDAs after they got from us a teaser. So 20 investors out of 30 will require an information memorandum. This will be a document with around 50 pages, 60 pages, so that they can have a close look at the business. Out of the 20, we would expect probably 8 indicative offers. Out of the 8 indicative offers, in a normal process, we will invite 4 for the next round. Out of the 4, we will see probably 2 very committed parties who will be very eager to spend time, resources, money, who will conduct a due diligence, who will look in much more detail at the market, at the management team. They will require workshops. We will do site visits. The other 2 will be more reluctant to spend more time. They will be behaving more opportunistic. So we have a very interesting tool in our processes. This is the electronic data room. All the bidders in the second round have access to electronic data room. And we, on the sell side, as M&A advisor, we can then monitor who of the bidders are acting and going into this data room. So we have bidders where maybe a team of 50 people are very active in the data room and they looked at 5,000 documents. We have other bidders who only go in the data room with 3 or 4 people and only look at 100 documents. So they're completely different dynamics. So in the second round, normally out of 4, 2 are very hot and 2 are waiting what will happen, behaving more opportunistic. And they might become hot in case they see that the most hottest parties are maybe drawing back from the process for whatever reason.
So I think the important point is typically in, let's say, small mid-market companies, you don't have the resources to, let's say, act with 5 parties on the same level. Which means if you are really interested in a company and if you are, let's say, one of the 2 which are hot, and if you are quick, then you have a very high chance to buy a company like this also in an auction process.
Absolutely.
So it's not what like the people think, oh, it's an auction and then there are 100 parties and then you have 5 interested which give a bid at a final bid and then 3 parties sitting in, let's say, in a house and at the day when the signing is, somebody decides whom to give it, who pays the highest price at the end. So that's not a typical auction in a small mid-market company. So it's very important that you really are committed to the process and that you are fast. And then you have a high chance to buy also a company in an auction process.
Absolutely.
But the problem is most people are not willing to be fast and to be hot.
This is true, unfortunately, yes. To my big surprise, actually,
So
sometimes.
kind of make the auction proprietary to you. It's kind of get more information, dig into it, and then be fast, and then you don't have actually 5 co-bidders driving up the price.
You never have.
You never have, but you usually don't know, because Michael is doing a good job in hiding that from you. that you're the only one left, at the table.
You have to have so much questions during the process that they are not able to handle with more than 2 parties. So much question which you ask.
If you are smart, experienced private equity house and auctions, you can read how the management reacts to your questions. Whether there are 3 or 4 other very hot parties in the auction, or whether you raise the first time the question, whether management team is always available, or whether we are not able to provide you with time slots for expert sessions and so on. I think private equity house who has experience in auctions will always will improve its likelihood to win the auction. But at the end of the day, the biggest competitor for private equity houses are not other financial sponsors. The biggest competitor today and even more in the future will be strategic buyers. They will gain of importance in these processes. Also in the mid-cap and the lower mid-cap sector.
Yeah, but it depends in which sector. Yeah. In the lower mid-market, typically the strategics are too slow. So when we do an exit, we have quite often the problem that the strategics are too slow. So let's say when we sell a company which is 50, 60, 70 million in size, the strategic who could buy this company or who are interested in this company, so they are too slow compared to the financial investors. Even if you give them a month or 2 months in advance, no chance. At the end of the PE house are much faster.
It's correct. The question is whether the seller, really needs a transaction within a short period of time, or whether he's prepared to wait a couple of additional months. But then he will also increase transaction the risk that he will have a broke auction. It all depends. So sometimes we have this very difficult question: what do we do? And it's very difficult to advise our clients what to do. They might have a very attractive offer from Nordholding or Brockhaus private equity. On the other hand, we might have a Chinese strategic buyer who is coming up with a very attractive indicative valuation. So what to do? Should we wait? Should we cater, the Chinese investor for another 3, 4 months? How will we be able to put Nordholding and Brockhaus private equity, on the back burner? Keep them a little bit happy.
Not possible.
It's not possible. So it's very difficult. So sometimes as an owner you have to take a decision, and sometimes it's wise to leave 10% price premium on the table, but take a secure deal with another private equity house. So it also has something to do always with transaction security.
I think what Michael said is completely right in terms of if you're experienced with a process and you get in front of management, you can pretty much tell where you are in the rank. Last week I had a management presentation where the guy was sitting like this, right, telling really slow. So it was clear that we are not the front runners there. But on the other hand, what are you doing then? Because you still like the business, you still think that it's a buy for you, and you basically then have to decide, whether it's early on after the first management presentation or whether it's when you have spent a significant amount of money, whether you will want to continue and try or you want to drop out because the resource deployment doesn't make sense. So it's a difficult decision usually. But going back to the first one, I do agree that if you enter a process, you have a good amount of information flowing back from the banker or flowing back from the entrepreneur or the management, whether you are actually able to do it. And this also comes back to Mr. Effinger's point: is if you only have 2 that are very terrible buyers, you will certainly know quickly whether you are one of the 2.
I think it's really good to hear. That these auctions are not all that bad, no? So if you put a lot of energy and resources in there, a lot of money, then you can really be successful. So
absolutely.
on the other hand,
you still pay too much.
Yeah, that's why we will spend all this energy and resources in direct sourcing.
No, but auctions, they might be very surprising, especially in the mid-cap sector. Each auction is different, each seller is different, and each seller might have completely different objectives. I remember situations 2.5 years ago where we sold a family-owned business. The owner was 72 years old. He built up the business on his own. Very emotional seller. He hired me 9 years ago During 7 years, nothing happened. But then after the second heart attack, he decided, okay, I need to sell now. So we conducted a process. We approached strategic buyers. We approached also Jan and his fund.
Yeah, I remember that one, yeah.
So
we don't own the business now.
And so it was a very emotional process because the owner of the businesses decided to sell the business, but he didn't want to sell the business, but he needed to sell the business because he didn't have any success in his family. And he was getting older and he was ill. And so his family pushed him to sell the business, but he didn't want to sell the business. But for him, it was not about making money. You know, we as investment bankers, we have been incentivized to generate the highest sales price. And let's say that in this situation, the strategic buyer came up with a bid of 100 million. And for us, it was a good deal for Lincoln because we came into our incentive fee kicker in our ratchet. So we were earning a lot of money if we would close with a strategic buyer to this value. But then the guy, he called me a couple of times. I needed to drive with a car in the evening from Frankfurt to the Ruhrgebiet. And I was sitting on a sofa and he said, Mr. Drill, I can't really sell the business to this strategic buyer. He has been my competitor since 30 years. It blows my brain. I can't do it. We need to sell to a financial sponsor. I said, okay, fine, we sell to a financial sponsor. The problem was that the financial sponsor maybe had a gap of 25% in terms of purchase price. So financial sponsor will only be able to come up with a bid of, let's say, 75 million because they lacked synergies and they needed to approach it in a different way. But then my client really for a certain time was prepared to sell the business for 75 rather than for 100 because he didn't want it, you know, to give the business to his competitors. So what I want to say with this anecdote, you know, mid-market M&A sell sides, one is different to the other, very emotional. There are always lots of surprises. And this is what makes our life, our business life, you know, so fascinating. It's much better than, you know, selling business for 5 billion. If you want to sell a huge subsidiary for Deutsche Telekom, this is boring because, you know, there's no emotions, there are no personality involved. This is very much rational. In our segment where we are acting, you see a lot of very interesting situations, a lot of interesting personalities, and this makes it really fascinating. And therefore, the outcome of each auction is never clear up front. So we only realize after 9 months what will happen. And this makes it really fascinating for us.
Thank you. Yeah, good. Maybe we have, so actually we have 2 minutes left. I think we can move on with the Q&A session and hand over to the audience for questions around proprietary deals. I think we have heard very, very interesting aspects from the market participants. From an academic view, or maybe from some of you also come from the business side, please feel free to ask questions. Yes, please. Hold on a second, you were getting a mic. Yeah.
Hello.
Hello.
Hello. Oh, sorry. My name is Nestor from Copenhagen Business School. Thank you for the presentation and for the panel discussion. My question is related to auction, M&A auctions. How many of them are actually successful, and what happens if, for example, the company cannot be sold at a certain auction? Does it go back, or what really happens in this type of environment today?
Thank you very much. I think good question. What happens if it doesn't work?
In an auction, you will always be able to generate bids and offers. The question at the end of the day is whether these offers are attractive to our clients or if they are not attractive. It's always too easy to sell a business. You can sell it for €1, but even there are companies which are difficult to sell for €1. We have been selling companies for €1 where the sellers needed to give, you know, an additional gift of, let's say, 20, 30 million as well. So we are, at the end of the day of an auction, we always have binding offers. The question is, are they attractive or not? It always depends who's the seller. What was the objective of the seller? Does he want to maximize his proceeds, or Does he want to get rid of a problem? Think of a large corporate who wants to divest the non-core business, which is diluting overall revenues. In this case, there will always be a deal. Clearly, the seller might be disappointed because he doesn't get what he initially wanted to get, but he will sell it. There are sellers who don't need to sell. Private equity houses, family-owned businesses, if they come up with a view that the binding offers are far away from the value they initially expected, and they believe the business still works, then clearly, yes, these auctions are pulled. And then the owners might wait for another 2 or 3 years before hitting again the market. I think if you pull such an auction, I think you need to wait another 2 years, further develop the business, think and reflect what was done badly in the sales process. Then you will have a chance, next chance maybe after 24 months. How often does this, in how many percent of the cases does this happen? I would say in our auctions, I would say 5 to 10%. 5 to 10%. If an auction is not doing well, normally it might take 18 months, it might take 24 months, but I would say only in 5 to 10% of the cases, the auction will be pulled. But in these cases, sometimes the owners don't really have realistic price expectations.
Okay, thank you. Maybe for Q1 2014, any indication on auction livelihood on this year? You mentioned that it's not so easy, it's so lala.
The environment is not so easy these days, and I probably you will share it. So deals take longer. Count trading of the business which we are selling are not doing so good. In most of the cases, we are only in line with budget or slightly below, and this clearly doesn't help, you know, for hot auctions.
The company you're selling for us is very good performing, actually.
There are
exceptions.
Some good exceptions. But the economic environment in Germany is not so strong in 2013 nor in 2014. So deals take longer. Strategic buyers are more cautious. They take more time. They are much more diligent in the due diligence process. So it takes more time. But a lot of people are spending time in looking at acquisitions. This is the good news. The bad news is deals are taking more time than before. And we would expect that we will see a small increase of overall transactions, overall a small increase of buyouts in Germany. So we see a little grow in number of transactions, bearing in mind that we come from a very low level 2013.
Okay, thank you. I think we have a couple of more questions. Gentleman in the third row.
Do I need a mic?
Yeah, I think it's better, because then the rest of the audience also.
Kuala Imperial College, and I've got a question about exits. So what is the thing that goes bad often, and what are the risks in exits, and how do you mitigate them?
I think it's all about timing, to be honest. You know, you have a certain plan, where you want to go with the business, whether it's 3 years or 5 years or even longer, and then overlay to that you have the macroeconomic environment, the M&A market that Michael just mentioned, and I think both has to overlap. So you need to have on a company level, you need to have the right performance, because the last thing you want to have is, from a psychological aspect in the whole auction process, is that you don't hit budget and you don't hit current trading, because you need to deliver good news throughout the process, otherwise people get nervous. And if you under promise and over deliver, that's always helpful in that regard. And the macro aspect needs to be taken into consideration as well. I mean, if you look last year or throughout the crisis 08, 09, you could have the best business, and this is why those vintage years for private equity are certainly the best, and no one would be interested, because everyone is so shy and shocked and in awe what will happen with the world in general. That no one is out there to pay high prices, and I think it's timing and it's performance, basically, those two aspects.
May I add something? Just one point. Thank you for this question. Very important, because people speak about proprietary deals, M&A, but not so much about exits. And if somebody asks me what is the most important thing about a good PE fund, I always say exit-oriented, because nobody expects this. If you would look, maybe 20% of the funds are really exit-oriented. They all speak about money multiples and IRRs, but when you have a meeting then with them, so when will you sell this company? Yeah, we will sell it maybe this year, maybe next year. And then you have afterwards a meeting with the CEO and ask him, did your shareholders speak with you already about exit this or next year? No, it's too early. No, it's too early. Maybe the year after. I mean, it's a PE house. It's a CEO of a PE house. He should know that they want to sell his company when it's the right timing. But that's not something which you will meet once. It's quite often that you have things like this. So exit orientation is the most important thing for successful PE houses. Quite often they love too much the companies, like entrepreneurs when they are successful. Maybe they don't have so much portfolio companies which are successful, so they love the good ones more, too much. But it's very important to be exit oriented. And better 2 times in 3 years than waiting for the 4x, and then you have a downturn and it's too late.
I don't agree so much with that. So
then you are not a successful one.
You know what makes a successful? It's not about the exit orientation. It's about having a successful exit. That's what it's about. And honestly, our CEOs, I mean, they are not working towards an exit. They have only one thing to do, is to develop the company, create value, and that's what they are focusing on. And then it's just natural that you will have a successful exit. And also, you're not looking at market timing, or we are not looking at market timing. This is nice to have. No, it's nice to have on an M&A if you ride a wave, but we are not wave riders. No, we buy the right company, we develop it, and by doing that, you're already planning an exit before you even bought the company. Because when we look at it, we look what is the value we can create, and of course we look, will somebody be very interested to buy this company once it doubled in size? And that comes naturally. And then it's not a wide auction process where we need to have the lucky one who really pays the highest price, because then we already are in contact with strategic parties for quite some time, early in the portfolio, and then it will come naturally.
It
will optimize for us, but that's it.
Yeah, it may come naturally, but I do think the macro aspects matter. Because if you sell it to a strategic that is, for example, listed, and these guys usually trade at 12 times, and in the trough they trade at 6 times, they will not pay 10 times, 12 times for your business. At least they will have a hard time to do so if it's a sizable transaction. So I think the macro aspect does matter in terms of timing when you go out. Even if you have identified the right buyer, you certainly would time it to the aspect that these guys are, can deliver.
It's the topping of the cake, no? But if you have the right exit or the right asset that they are looking for, whenever it will come to the market, the parties will be there.
I disagree.
Me too. And also the CEO should be exit-oriented. And if he is not exit-oriented by himself, you should have in every board meeting discussion about what is the right buyer, what network do we have to build up. I think that's very important.
I would agree with both of you. I
think to sell for both of us.
No. Wait. I think the exit, this is where you make the money as a sponsor. In the exit. If you do a good exit, this is where you create the value. And I also agree that some of the funds, they are not acting very professional on the exit for whatever reason. And one reason might be that the incentives for these funds in terms of management fees are not well balanced in Germany over the last 10 years. We see a lot of portfolio companies within a certain of PE houses in Germany, which could be up for sale already for some years. However, for certain reasons, we have the impression that the portfolio managers, they try to stick with their portfolio, they try to sit on it because they're incentivized in doing so, rather than creating value for their investors in having a fast exit and increasing the internal rate of return. So if you look at German portfolios of some of German mid-cap PE houses...
Now we're speaking about a desperate part of the market.
maybe. But this is also I think which could be explored by students in a PhD holding period of portfolio companies. And why do some funds intend to have longer holding periods, and what's their incentivation in terms of their management fees and performance fees?
Interesting discussion, obviously, but we're running a bit out of time here.
All right.
So on behalf of everyone from us, many thanks for making the time to get to our conference. We've prepared a couple of presents for you, and they will hopefully serve as a reminder of the conference and motivate you to come here again here soon. Many thanks.